Well, hello, everyone. We are so excited today. We are talking about how to grow, scale, and exit your business. We have an amazing guest with us. We have Dane DeSantis, and he is an expert in all things business brokering, and he's got so much experience. So we're going to dive right in. I have my wonderful co-host here, Ryan Finch, and we are going to dive right in. So Dane, let's start real quick with talking about. First, I want you to tell the story when we first talked and we said when we meet people, we're the ones that have to tell people that their baby is ugly. Let's start with that.
Absolutely. Everybody thinks they have a wonderfully beautiful baby, and most of us do, right? But when you're talking about business, oftentimes sellers don't understand that you have to identify the things in your business that a buyer wants when you're trying to sell the business. So oftentimes to a buyer, your business may look ugly, and we can help you make it look a little prettier.
So what are some of the key items that people need to help determine what the value of a business is?
So understand value of business can be determined a variety of different ways. Percentage or multiplier of revenue, of profit, of things like net owner benefit or seller's discretionary earnings. But at the end of the day, what you're really going to look at when it comes to value are the financials and most importantly, the tax returns. Every business from an industry perspective will most likely have some sort of multiplier that you can go off of, but then each business within that industry could have a different multiplier based on the things that are happening within the business.
So would it be based on revenue or profit, or does that vary?
Varies. So when you're talking about revenue, the multiplier would generally be lower. I tell all business owners, what does any business buyer want? They want the money that stays in the business, not the money that comes in the business, right? Revenue is the money coming in. The profit is the money staying in. So the money staying in is really important.
Let's talk about that for just a second, because I know you just were coaching someone on that just recently. They were doing so many business expenses, like they were taking clients out to eat and they were having all these charges that, when we were asking them, okay, what is this about your business? And he was using a lot of stuff for personal that he was kind of acting like it was business.
Well, the big thing I think is that you want to use expenses running through it. So if they're eating out or car expenses or things like that, you want to run through the business so you're not paying tax on it. The trade-off in that is when you're going to go exit the business, that obviously then you have those in and now you've lowered your profit.
Yeah. And that's where it gets hard because they're kind of like, they don't want to pay taxes, but then the valuation on their business isn't as high. So let's talk a little bit about the difference between a P&L and a balance sheet. Because I will tell you, most businesses that I talk to, they all know a P&L. They all are like, yeah, this is my profit and loss, blah, blah, blah. But when you talk to them about a balance sheet, they don't even know what the balance sheet is.
So it's real simple. And you're absolutely right. But as important of understanding what each one of them are, as a business owner, you should know what's in your P&L and what makes up your P&L. So let me talk to you about that. A P&L, just in its simplest form, is a snapshot of what's coming in and going out of your business, revenue and expenses. It's pretty much that simple, right? A balance sheet, put very simply, is what you own and what you owe. It's your assets and your liabilities. It's literally that simple. I get this question a lot. I'll be talking to a business owner and we're towards the end of the year and they do a P&L for, let's say, through the end of November. And it shows that their profit is $100,000, 200, whatever the number is. They'll look at me and they say, well, how come I don't have that much money in my bank? That is a question I get asked a lot. And the reason is you owe money on loans. You're not going to see that on your P&L. That's going to be on your balance sheet because you owe that as a loan, or also with your business accounts. That's what you have, right? You have that money as an asset, but then you owe money on your loans, and those are the things that you owe. So you're not going to see that on your balance sheet. So that is a question I get often a lot from sellers.
Which is also beneficial, right?
Of course it is.
Running an asset or a property or a business, you're paying off debt. The amount going toward the principal is actually balanced. So as the business is running, it's paying off its debt for you.
It is. And the thing, though, you get what will be on the P&L is the interest you pay. right? And that would be considered an add back.
Which is also a cool thing, because if you go in and interest rates go down, you buy a business and you go refinance that debt out, you lower down the expenses, you increase the profit, you've grown the value of the business.
Absolutely.
Without even changing any operating things.
Yes, correct.
So let's give people a real example for the things that would be on a P&L versus the things that should be on their balance sheet. Let's pretend it was a landscaping company. So name some things, because a lot of times people are like, what kind of things should even be on the balance sheet? So let's talk about that.
So if you want to start with the balance sheet, you're going to have your accounts. If you have a checking account or operating account, a savings account, whatever money that you have in a bank account, those are your assets. You're going to have all of your equipment listed, should be. If you have any inventory, some landscaping companies carry inventory, some don't. And then you're going to have retained earnings, things like that. If you have credit cards, if you have any sort of debt, loans, those will all be on the balance sheet. Okay.
Yeah.
Where would accounts receivable be?
That would be on the balance sheet, as would accounts payable. So because those are assets and liabilities. Thank you, Ryan. Good job. And then from a P&L perspective, right? It's anything you kind of need to operate your business on a day-to-day. Your revenue that comes in, your cost of goods that you buy, and then all the expenses, insurance, gas, maintenance, really anything else that you would need to operate the business on a daily basis. I mean, there's lots of things: meals and entertainment, travel, telephone, internet, website, all those things that you're using to operate the business.
So one of the things I want to talk about is, I think that what happens is because they're not looking at the balance sheet, they're just looking at the P&L. And we do something called Financial Fridays. So we meet with our accounting girl on Tuesday. She runs through everything. And then on Fridays, we meet to kind of talk about all the different businesses that we have. And we don't just look at the P&Ls, we also look at the balance sheet. I think it's important for a business for at least once a week, sometimes twice a week. We do it twice a week to kind of keep it, but at a minimum once a week for you to be able to know your numbers. What do you think?
Absolutely. I would say just as important as the balance sheet, the P&L, you should be looking at it constantly. Now, there are some businesses that don't move, money in and out weekly. There are some that do. So the more frequently you get money and the more frequently you send out money is the more frequently you should be looking over your P&L and your balance sheet.
There's two things. One is we found today we were looking is we sometimes borrow from one company to another. So as you borrow, you use money to bring in for arbitrage. And in doing that, we find that it's showing wrong on the balance sheet by condensing it. So that was one of the things we found, it was showing from two different companies versus one company.
Right.
So we cleaned that up. And the second thing I was thinking is, I've seen two different styles of business, right? The first business brings in all their money, let's call it on the 10th of the month, and then expenses afterward. And the other side is they have cost of goods sold all the way through the month. So they sell a new product all the way through. What are your thoughts on how that operation sets up?
It's going to be different for every business. I mean, it's hard to say that there's one that's better than the other, or one industry should use one or another. It's personal preference. Your CPA is probably going to have an opinion.
What do you like?
P&L. I like cash flow.
Yeah.
As long as I have money and I know what's going out and what's coming in, and it's a positive, more positive than not, that's more important to me.
Well, and I will tell you, I just saw a really crazy study that it said that right now, in most small businesses, they are 30 days away in their cash flow from going under.
Yeah.
I mean, it blows my mind that people do not have, and Dave Ramsey, he's always talking about for your business, you need to have at least 6 months in savings, sometimes a year in savings. What are you seeing for businesses that they have? Because that study said they've only got 30 days. That's it. The 30 days they're going under if they're not bringing in cash flow. Dave Ramsey says you should keep 6 months to a year. The better businesses are a year. What are you seeing in some of the businesses that are coming to you? Where are they at?
Most of the businesses that I'm working with have very good cash flow. So they're going to have a savings account of at least 6 months, most likely a year or more. So when you've positioned yourself well to sell, you do have that money. Speaking of statistics, I mean, what is the statistic? Most businesses fail in the first 5 years, right? So the reality is a lot of sellers are still stuck in that technician stage. They can't delegate, right? And when you can't delegate, everything is reliant upon you. You can't grow, you can't scale. And
You should get my book, Delegate Everything But Sex.
Well,
and that's the reality, is those businesses that you're talking about, they aren't that entrepreneur. They're not that visionary. They're still stuck in that technician stage where they're doing most of the work themselves because they're incapable of doing that.
Yeah, absolutely.
Do you think it's easier structure-wise selling a C corporation, an S corp, or an LLC?
I would say a majority of the businesses that I work with, 99% are an S corp of some sort, whether that's an LLC operating as an S or just a straight S. We don't do many C corps.
There are some few businesses that, well, and if you ever want to take your company public, like for me, I wanted to take one of my companies public, so I had to make it. We were an S corp, and you have to be a C corp in order to go public. So if that's your goal, and in your mind you do want to take the company public, you will have to switch to being a C corp.
That ties into the exit, right? So when you're opening a business and how you're starting it, you need to plan how you're going to exit. If you're going to sell off shares or units, whatever you're going to do. If you're going to raise debt against it, all these things would be valuable information to think about.
Yeah, for sure.
And they could find out about that from us, couldn't they?
Yes, they can.
I want to talk about a few things, terms that you really need to be on top of in your business. So I want to kind of talk about seller discretionary earnings, net owner benefit, and EBITDA, and how they all tie in and relate to one another.
Great. So net owner benefit and seller's discretionary earnings are interchangeable terms. EBITDA is essentially earnings before interest, depreciation, taxes, and amortization. So that is on a higher level, right? So you're basically taking the profit, any taxes that were paid, any depreciation that was paid, any interest that was paid, and any amortization that was paid, and that's your EBITDA number. Essentially, what seller's discretionary earnings are, or net owner benefit, is then you go back into the P&L, you take those things that we talked about, EBITDA, and then things like the owner's salary, the taxes, the medical insurance, the travel, the things that the business owner is benefiting from owning that business, cell phone, things like that is what becomes seller's discretionary earnings or net owner benefit.
You're going to say that, hey, you're selling your business and you're going to lose these on top of selling at a multiple of the profit.
Both.
Yeah, and I think it really depends on the way that you decide, and I think this is really important, of whether you decide the value of the business when you're doing the valuation is how involved is that owner in the business. Meaning, if you truly are, you aren't doing anything. You are literally just sitting back, sitting at the beach. You're doing nothing. Then, which is very rarely the case.
It is very rarely the case.
The money that they're getting for salary, you can say, okay, we can add that back in. We can put that for when we're doing the evaluation. But if they are doing 10 hats and let's say they're taking a salary of 120,000, but then in order to hire someone to do all 10 hats, and it's going to now cost 300,000 to replace those 10 hats, talk about that.
You probably can't sell your business. I mean, it's just that simple.
The argument, doesn't it? Because say, oh, I'm not doing anything, and the buyer's saying, I bet you are. And so then why are you getting paid if you're not doing it because you're lowering the number? And so now you got this tug of war going on.
Yeah, look, the reality is, and I just talked about this with somebody yesterday, buyers buy businesses based on two things: finances.
If you're writing, taking notes,
cash flow, money, and risk.
Risk?
The less risk a buyer has when they buy your business, the more they're going to pay for it.
So for that's reoccurring revenue, right?
That's one of the things.
Yeah, so as they have reoccurring, they can see contracts, they can see government contracts,
stability,
like that.
That's what you're talking about.
They know what money is coming in.
Correct. And if the business doesn't have a reliance on the owner, that's another de-risk, right? Because you've got a C-suite of people, you have managers in place. Look, the reality is, as I started to talk about earlier, from a valuation perspective, if every industry has a baseline of 2, 3, 5, whatever number you want to use, it doesn't matter. If there's a scale, the more recurring revenue you have, the higher it goes.
Right.
the less reliant it is on the owner, the higher it goes. The more SOPs you have in place, the higher it goes. The more stable your financials are, the higher it goes.
The culture, the employee,
all of
the
that.
financial structure, the
Yep.
debt structure.
Yep.
I mean, it's fun. It's
Yes,
a fun game.
it is.
Assessing businesses this way, isn't it?
Now, the less you have of those, the less your business is worth. So that it's a scale.
And that's one of the things that we can do for you is we can actually have a full evaluation on your business. It includes 4 coaching calls as well, but then we give you a full evaluation where we say, this is what your business is worth right now. And we have all the tools to get you that number. And if you wanted to get an SBA loan, that evaluation you would be able to use for that SBA. But before we get too far, I do want to talk about an add back on a P&L. Someone asked me about that the other day, didn't know what that meant. Explain what an add back is.
An add back is simply funds that the owner takes for themselves. If the person buying the business wasn't or took over the business, they don't necessarily have to take that out of the P&L. And if you don't take that out of the P&L, your profit goes up.
So car.
So like a car.
Yeah.
That's it. Yeah. So let's say you're selling a restaurant. You don't have to put your car payment, your car lease payment through the business because you don't necessarily need a car. We're not talking about delivery. We're talking about the owner writing off their car loan, their car lease off in the business. If that car lease wasn't there, let's say it was $12,000 a year, if it wasn't there, their profit would automatically go up by $12,000.
Right.
So that's an example of an add back.
Now, one of the things, we were coaching someone and I get this question all the time, and I know you do too. So they're looking at their P&L and they go, we made January I made 20,000, February I made 30,000, March I made 30,000. And if you add that up, that's $80,000. But if I'm looking in my bank account, there's not 80,000 extra in the account. And they're always like, they can't, do you not get that question all the time?
They're irregularities.
Because they're like, wait a minute, if I do the math, 1 + 1 + 1 is not equaling 3. That's what they're basically saying. So how do you account for that?
Balance sheet. What are you paying out in loans? What are you paying out on credit cards? Because those don't show up on the
really practical example.
Sure.
So we'll just say 10,000 in January, 10,000 in February, 10,000 in March. Let's use this landscaping company. So I just met with my accountant. She said $30,000. Now he's like, but I'm looking in my account and it's not there.
You have a truck that is a $500 loan payment. You have a stump grinder that has a $1,000 loan payment. That's $1,500 off of each one of those months that will not show up on your P&L because it is an asset and then the loan is a liability. So remember, the position of cash at the moment is essentially, if you reconcile, that's your balance sheet. Right? That's what's going to be in and out. Your P&L is what has come in sales and what have I paid in expenses to make those sales happen, right? Again, we're not talking about assets. We're talking about the things that those assets need in order to operate.
Like the stump grinder.
You need gas, you need new blades, right? Those are items that you're buying in order to make the stump grinder work.
Yeah.
What about disbursements?
Those are also balance sheet items as well.
So now the bank account's going to be lower, even though it's not showing it on the P&L.
Right.
Yeah. So that's why the money is not adding up. All right. Let's talk about SBA loan because as we know, approximately 85% of all businesses are sold. And obviously it depends on the size of the business, but the lower end businesses, about 85% are going through the SBA loan. So let's just kind of give them an SBA loan dump, like everything we've learned from selling different businesses, things that are important for people to know when they're looking to get the SBA loan. And then I'll have you talk about some of the private funding.
Sure. So SBA loans stands for Small Business Administration. It is a government-backed loan that banks are giving to potential buyers. Okay. So what are some of the things you really need to know about SBA loans? And this is good for sellers to know too, because they want to make sure that they're, from a business perspective, their business is put in a light that will be beneficial or that will be good for the SBA to loan upon. Okay. So your P&Ls and your tax returns need to match. They need to match. It's really important because a bank is only going to use your tax returns. Yes, they're going to look at your P&L, and obviously if you're in the middle of a year, you don't have a tax return. So they're going to look at your P&L and your balance sheet. They're going to compare years from previous to a year-to-date time frame. So January through June, if you're selling your business in June, for example, they're going to look at that 24 versus 25, or in this case, 25 versus 26. They're going to look at your balance sheet. One of the things that I often see is sellers don't put their inventory on their balance sheet or their tax returns. And banks are like, well, how are you operating your business, but you don't have any inventory? There's a lot of reasons for it, but it's important.
Give a practical example about the inventory, because I think that's important.
You should always be tracking inventory, and you should have on your balance sheet what your current inventory level is at a certain time period. Quite frankly, you have to pay tax on the inventory that you have on your business. So sometimes the inventory isn't.
Use the example of the landscaper.
Mm-hmm.
There's a medical company I know about that had it. They had all the stuff stocked in the thing. When they went to go sell the business, they could even do the value based on the inventory because they were selling the inventory. And they knew how many times that inventory rolled over by keeping calculation on that as well.
Right. Yeah. It's important that you put that on your tax return, and more importantly, in your balance sheet. Some people don't track it. There's a process to tracking inventory. So some people just don't want to go through it, or it turns too quickly. Right.
Like turf. If they have all their turf that they had, if they stocked a bunch of landscaping.
Not for a job. Well, I want to be clear about that. We're talking about inventory that's kind of sitting on a shelf that you sell in a warehouse, right? Not buying inventory for a job. That's not what we're talking about. Okay.
Right.
Are you looking to open a landscape company I don't know about yet?
I don't know. I just think it's a pretty simple company. So I like to use examples with that. But yes, that's a good point. So if you're doing a job for a landscaping position, and you knew I'm buying, these 5 trees. I went that day, went to the nursery, bought those trees. We're not talking about that.
No.
But if you've got turf is a perfect example. You bought that in bulk. It's sitting in your warehouse.
And you sell it individually. Yeah. I mean, that's the inventory we're talking about.
Well, and this is one topic, and we're talking about the SBA loan is we can't give them all the information they need to know. How long would it take if I bring my business in? How long do you think it takes to get it right for SBA?
That's a very hard question to answer because I don't know where it is. Yeah. But when we work with a business and we're working to help them sell it, we're putting it through the process as if they were going to go through SBA.
So they should bring it sooner than later?
Always.
So, hey, I want to sell it now.
No.
I should give 3 months, 6 months to give you a chance to get it right?
Me, 2 years.
2 years.
I want 2 years.
Okay.
Because I might have to help, not me. We might have to talk to the accountant, and we might have to go and help them amend a tax return.
Okay.
Right? Because you want to put it.
Because the tax returns is to match the P&Ls.
Correct.
And how many times do you see that it's not matching?
A majority.
Like, would you say like 70%? Is that probably a good 70 to 80%?
You're going to be pretty baby.
Yeah, that's the goal. That's the goal, is to pretty up and put a bow in its hair and stuff like that.
Well, what makes using an SBA loan to buy a business unique?
Unlike a conventional loan, generally speaking, the amount of money you have to put down to buy the business is much lower. It's about 10%. You can get away with putting 5 and having the seller hold a note for 5. There's lots of different things that you can do. But speaking from experience, most people are going to put 10% down. So you're buying a business, and this is the way I do it. You're buying $1 million business, and that business should cash flow anywhere between 200, 300, 400, 500, whatever it is, because you're obviously using a multiplier. You have to put down $100,000 to buy a business that's making you $300,000 or $400,000. It's a pretty good return on your investment. The bank will want you to have some sort of working capital as well, but you can also get that from the bank at a 10% down payment as well. So let's say I need $100,000 worth of working capital. If I bring another $10,000, I can get $100,000 of cash essentially in my bank account when I take over that new business. The things that are really important to understand though from a seller and SBA is, from a buyer's perspective, it's almost like a second level of due diligence, right? Because a lot of buyers say, well, if a bank is not going to lend on this, why would I want to buy it? One of the questions I often get too is, have you seen, I know interest rates have come down recently. Yeah. So interest rates have come down recently, but for the last 2 years, about 2 years, they were hovering at about prime was about 8.5. So you're looking at an interest rate for an SBA loan at 10.5. So I get this question all the time. Have the interest rates affected the ability for people to buy businesses? And this is what I would say. If a business that you're buying cannot account for a 1 or 1.5% increase in the loan you're going to have to pay, you should not be buying that business. The cash flow is way too tight. Because remember, how we buy businesses and how people, want to sell the businesses, if let's say the owner is making $500,000, it's an easy round number to work off of, and you're selling the business for $1 million, $1.5 million to whatever it is, that business is, the buyer is going to be taking on a loan. So if the original owner or the seller was making 500, the buyer's probably only going to be making 350, right? Or 300 or 250, whatever it is. So they have to identify, is this the money I can use to live on, to operate the business, to grow it, to scale it, to put more money into it? They're not making that 500 anymore. They have to put that loan payment into it.
But where else could you go put that kind of money and get that kind of money back, right? I mean, to buy that kind of asset and get that kind of stuff back. And, as you're tying to SBA, it reminds me of kind of the owner financing side. Do you want to go?
Yeah. So I want to talk about that because that's where I think we've blown people's minds with what we can do on that side. So go ahead and blow people's minds right now.
Well, first off, we'll just start. Is she not beautiful?
Stop. I say that, please. Don't. Right. I don't like that.
But she's good. Right. So essentially what we've been able to do is go and find, and I like them almost in the smaller side of business. If you can get a chunk of a $500,000 business or something like that, even if that's part of the note, you could have $1 million business that has 500 in a note. You can take that note and take that paper and finance it. So it really doesn't even matter what the interest rate is, right? Because if SBA is at 8 or 9%, you could give them 5%. It's going to be based on the payments, and we can take the payments and go to a fund, and we have access to a hedge fund that comes in and we sell off the note to it. So when we go take a business, we will go buy it, let them take the note back with us, and then they can go turn around and sell the note and get the cash. And now we're just still on a payment schedule. So they get all of their money right there. Yep. And inversely, we've done the same thing. We've sold a business, somebody comes on for the note, and then we just go sell the paper. So
I'm not getting fresh, but that lint was bothering me.
It's been a huge asset. I don't know, where were we?
Well, we talked about that the first time we met.
Yeah.
And it was like, oh, wow, that is such a cool thing. I'd never heard anything like that. So it's a tool in your toolbox.
Well, the way I look at it is we can take the other businesses that don't want to wait 2 years. They don't want to go through the SBA. They don't want, and we can take them and then package it and put it together. Then you have the buyer that says, I want to buy a business and I don't want to take 6 months of due diligence. It's either it covers the cost, they're going to finance it. Here's the amount of money down. Let it pay off the debt for itself. It covers it and pays me my money back in this amount of time. And it's just quick, easy math for the average person who just wants to buy a business.
So I think one of the things we should talk about, which is really important, is like, what are the ways to fund a business acquisition?
Yeah.
Right.
Before we talk about that, I want to talk about one thing because it's just really coming up for me. And if you're listening to this, I need everyone to understand they need to call us right away, because what I'm seeing is some of the people that are calling us are so burnt out that by the time, literally, we have a company, it's a lotion company. He's like, I'm done.
Just take it.
Yes.
Just take it.
It's like, you can have it. It's making $300,000 a year in cash flow. No joke. And he's just like, I'm done.
Is he living in Hawaii or something?
No. He's in Georgia. So the bottom line is that what happens is number one, if you want us to help you get your company to, instead of a $1 million valuation, to $3 million, it takes a little bit of time to get us to get you there, first of all, or to even 10 million. But the second piece is when you get to that place where you're just so burnt out, then
call us anyway, because then we can buy it. Don't long answer here.
I want them to call us before, because there's a transition period too that they need to, and you don't want to sell when you're burnt out. Talk about that.
Well, I mean, ultimately, once you get burnt out, your passion's gone. You're not driving the ship anymore. You're not creating the vision. You're not waking up excited about what's going on. And somebody coming in kind of can smell blood in the water when it comes to that.
And now they're offering less, and now you're like, sure, take it.
Well, and I even look at it like, if you're not doing that, eventually there's people that are like the baby boomers type are waiting, and these businesses are going to pass down to their kids, and their kids have kind of lived off this business, but they don't know how it operates. And then those are going to sell for less. So it's like structuring it for a sale, even if you're not going to sell it, and then getting that ready to sell before you pass it on. You could bring in all that cash now instead of having a huge loss by letting it pass through. So.
All right, now let's talk about what you wanted to talk about.
So there's really 3 ways to buy a business: cash,
Straight cash, homie.
straight cash, homie, loan, or seller financing, right? Any one of those 3 things can be intertwined with one another to get the result of what you want.
The art of the deal.
Doesn't matter, right? But what does the seller generally want when they sell their business?
Cash.
All their money
All
up
their
front.
now.
Right.
Their money now.
Of course.
They don't
And the
care.
buyer wants security.
They want security, right? So that goes back to what we talked about earlier, is if you can de-risk your business for someone else coming in, they're more likely to feel more secure, either pay you more, pay you the cash up front. And that's the other thing with the SBA, is the seller does get all their money up front, right? There are plenty of people who do the SBA with some sort of seller's note as well.
So just tell them a little bit. Let's say they come to us with a gorgeous baby. Their business
Sure.
is perfect.
Yes.
They say, and now we find a buyer immediately.
Yes.
But the buyer does need to go through SBA. Approximately right now, what would you say on average is the time that we're seeing from the time that we say all our ducks are in a row, we've got a great buyer, to the time it's closed?
And we're under contract?
Yes.
Okay, so we're under contract, and we're getting ready to submit the package to SBA. A good bank should close that within 60 days.
Mm-hmm. Yeah. And it could be as soon as 45. Like I've seen
It could be.
at 45.
Yes, it could.
You're right. 60.
It's 45 to 90, so that's where I went with 60.
Yeah.
I got a question.
Sure.
For both of y'all.
Mhm.
So somebody brings you a business.
Mhm.
I mean, they say the biggest thing I'm worried about is all my employees knowing that I'm going to have the business or whatever. Is there any, and we'll start with Shannon, is there any protectionary thing to somebody if they want to bring you a business to sell right now, to having it marketed but not have everybody know what's going on?
Yeah. So that is really important. A lot of people think, oh my gosh, I can't tell anyone, because first of all, and we're going to talk about that as far as what the timing is to like even employees, and that sort of thing, to even getting them to understand like, hey, we're going to be selling the business. But no one has to know. Like if you come to us, no one will know that your business is for sale. Like everything is under wraps. So no one's going to know until we get to that real due diligence time. And then we're going to have confidentiality, NDAs signed and so forth. You can answer that. Please.
Yeah. So the 2 biggest risks from a seller are the employees and the customers. So confidentiality in the business brokerage world is one of the most important things, right? So here's what I tell the people who ask me, when should I tell my employees? I tell them when the check is cashed.
Mm-hmm.
Or clear.
The flip side, I feel like this is part of it, is that if there's always that fear of the unknown for an employee operating that way for the seller, and at the same time, the employees don't want to lose their job, and the buyer doesn't want to lose the employees. So it's like neither party understands. Like, we don't want you to go when we're buying the business. Like, if you find out, we don't want you to find out because then you're going to leave, and we don't want you to leave because we need you to stay, because that's what we want to. That's what we're trying to buy, is a great employee who already knows how to run and operate the business. To convey that.
So the seller needs the employee more than the employee needs the seller.
Yeah, when the buyer
they
wants
know.
the employee.
I'm sorry, the buyer. That's what I meant. I apologize. The buyer needs the employee more than the employee needs the buyer.
Right.
Okay.
Right.
But what has happened? We've seen movies, we've heard our family members, their company got bought up by a bigger company and they laid off 1,000 people.
Mm-hmm.
And that is where they're coming from.
Right.
It's incumbent upon the seller and the buyer to have a very smooth transition. And here's what I tell every buyer. Does every buyer listen? Absolutely not. Do not change a single thing for 6 months. Even if the seller was a absentee owner, semi-absentee owner, because that's what a lot of buyers are looking for right now. They're looking for absentee owner businesses, which means it's fully run by a management team with employees under it. Well, that seller probably endeared themselves over the last 3, 5, 7, 10 years, whatever it's been. Now you come in as the new owner, you don't really know those people. So there's a possibility that the employees aren't going to act the same way because they don't know you. So yes, the former owner didn't really work in the business, but you're going to have to show up. You're going to have to show your face and get to know the employees, because that's really important. And we're talking about small to medium-sized businesses that have employees. I think that's really important to understand.
Yeah. So let's talk about the difference between a financial buyer and a strategic buyer, because I think those people can get confused on that. So let's talk about that.
This is one of the things that is changing in this industry, and it's changing fast. Strategic buyers and financial buyers have been around forever, but I'm going to just give you an example. So here's a financial buyer. Financial buyer is buying the business based on the cash flow, and they're expecting to have the same or similar cash flow to put in their pocket. Okay. A strategic buyer is buying a business so that the business that they're buying can either be rolled up into another business, or they're going to take that business and sell different things to the into the customer base. So I'm going to give you an example. It's happening right now in the HVAC industry.
Oh, yeah.
Oh my gosh.
Exactly why it's happening in the HVAC industry. And it's because of Cody Sanchez. And she's always like, you should buy boring businesses like HVAC, roof, laundromats, those kind of things. She's like, they're not sexy businesses. So she's been flooding the internet with that message. So everyone's like, HVAC, roof, laundromats,
Plumbing, electrical.
electrical, and every other podcast out there now
It
is
is.
talking about it.
But the change in the industry is private equity is coming way downstream. Private equity wouldn't touch businesses, under 10, 15, 20 million. They're buying businesses for 2 and 3 million now, because they're taking that $2 and $3 million business and they're rolling it into a business that is 15, 20. They want to get to 100 million and then sell it to a larger private equity.
We just had this new thing go on where they're taking hedge funds and not allowing them to buy up real estate, which means that money has to shift. So it has to be deployed. So which means now it's going to move from real estate. They were already making moves out of there into multifamily.
Yeah.
And now, so it's going to go to multifamily or into businesses because they're going to have to roll one of these two ways. And that was already in the pipeline. Sorry, go. What were you?
So talk about roll-ups, because one of the things that we're having so much fun doing, we just are helping businesses. We've got someone with an HVAC business. He just bought 3 different HVAC unit companies, rolled them all up, and then sold it. So talk about that.
Well, I mean, that's really the crux of that, is centralizing the services and putting those things together. And then the funds want bigger ones. They don't want the smaller ones. They want the big one. They want to move a larger amount of money. And so having access to collecting those together, and then the wherewithal to know how to synergize those, and then the connection to rolling those up.
So I've seen non-profitable HVAC companies being sold to private equity. Now, there's a caveat to that. They need to have those maintenance agreements, mostly residential. We're not talking about a person in a truck, right? They've got employees, and for whatever reason, they're not profitable. Private equity are still buying those because they want those maintenance contracts. They want those clients, and they're then rolling that up into a much larger company with the idea of being sold most likely in 5 to 10 years to an even larger private equity firm.
So good. Let's talk about seller expectations. So some of the things that they need to get together, first of all, and some of the things that they should expect, because I think setting those up front is important.
Really important. So the first thing they need to understand is, when I work with a seller, I really take them through, why are you selling? That's like the most important thing I need to know, because we may get through into the transaction and it might get hard. They've never done this before. I think most business owners who sell their business, it's the first time. When I say most, like 80%, it's a large number. So I really try to take them through, what are the expectations? How long is this going to take? What is going to be expected of you? So let's talk about some of those. Generally, how long is this going to take? It's gotten a little bit shorter, but on the higher side, it's 9 to 12 months, right? That's start to finish. We've listed, you have money in your bank account, 9 to 12 months. My shortest deal ever, which was so awesome, I had something listed for 15 minutes, right? And then we closed about 20 days later. The longest one was almost 18 months. So anywhere in between. So they already know how long it's going to take. All right. We're giving them a valuation, so they're giving me all the financials I'm looking for: tax returns, P&Ls, balance sheets, trailing 12 months, a comparison between years. We get all that compiled. We got to take pictures. They've got to give me information, because there's things about their business that I can't even pull out of them, right? So we've really got to set the scene, and then we set that scene, make it attractive for a buyer. And then we're going to start kind of talking through buyers. We're going to set them up and say, all right, we're going to get on a call now. You're going to have to talk about your business to this potential buyer. And generally those calls are non-financial. They're very high level. Tell me about the buyer, tell me about the seller. They'll ask some questions. And then oftentimes you'll get into another call, but you really want an LOI or a contract right from there. That's when the work really starts, right? What were the terms, as you talked about earlier? What were the terms of the deal? Is it SBA? Is it cash? Is it seller financing? What is it? We're going to go through, and as this process goes along, if there are a bunch of add backs, you got to prove those add backs. You're going to be giving us things like bank account statements, credit card statements, payroll statements. These are things that you should expect as a seller to give to a buyer during the due diligence period.
Now, do you use like a Dropbox for your stuff to put it all in and just keep one data file to a data room to give access?
We have a CRM and we use the data room, and there's access back and forth. Yes.
So they should expect to provide all that up front before they even have an LOI, because that way it makes it easier for the.
Yes, depending on how long it takes, it might have to be updated. But yeah,
Right.
things like leases, those are really important. Insurance, right? Because
One have insurance on the business?
yeah, at least one policy.
Okay.
But it's really important to understand, do you need your workers' comp? Do you not? Depends on how many employees you have, right? Is it liability? If you have vehicles, is it, just general automotive? Is it comprehensive? There's all these things that go into it. Insurance is a big one. Though the insurance slows down SBA deals a lot of the time. So there's two things that slow SBA deals down the most. It's oftentimes you have to get life insurance as a buyer, and that because the bank wants collateral. If something happens to you, they want to make sure the banks are in the business to get paid back on the money that they loan, right? And at a percentage, that's what interest is. And then insurance in general. What a lot of buyers don't understand is what an accord is. An insurance, it is that, but when we're talking about insurance, it means your insurance is bound. It means that there is something that if something were to happen, you can go back. It's not like I just got a policy or I just got a quote. Banks want the accord. They want your insurance bound. It's extremely important. And then the other thing that slows down purchases is a lease. If you're in a lease, getting that lease assigned or getting a new lease, these are the things that generally slow those down.
If they only have 3 months left on the lease,
Mhm.
they're like, that would be a nightmare for them to have to pick up, start moving. And if they couldn't renew that lease,
They can't assign a new owner to the lease, and so then that.
Or if the lease is ending, and let's say they're paying $3,000 a month, and the landlord says, your lease is going to $5,000 a month.
yeah.
Right. So then that comes off your profit. The value of the business is essentially less, or you move it through. There's a lot of moving parts. It's not a simple thing, but fortunately we've done it so much, we can kind of talk people through it.
So good. Well, this has been amazing. We are going to be doing another episode talking all about how your business is like cooking brownies. So that's coming up. Don't miss it. We're so excited. Thank you both for being here. You guys stay tuned. We'll be back in just a bit.